Have you ever peered beyond the daily market headlines, past the endless stream of hot tips and speculative fads, and wondered if there's a truly enduring secret to building wealth?
Something solid.
Exactly. Or imagine for a moment that the stock market felt like a casino with its dizzying highs and crushing lows.
Which, let's be honest, it often does feel like that.
It really can. Now, envision a completely different game one where, with the right approach, the odds are always consistently in your favor.
Ah, that sounds much better.
Doesn't it?
Mm.
Today, we're embarking on a deep dive into precisely that game, guided by a timeless blueprint for financial success.
And that blueprint comes from Benjamin Graham's seminal work, The Intelligent Investor. This isn't just a book on finance. It is, well, pretty much the foundational text for value investing.
It really set the stage, didn't it?
Absolutely. First published way back in 1949, and it's been meticulously updated over the decades to remain profoundly relevant, even in today's wildly complex and, frankly, unpredictable financial landscape.
Which is saying something, given how much has changed since '49.
It really is. Its enduring influence is almost impossible to overstate, particularly on figures like Warren Buffett.
Right. Buffett always talks about Graham.
He does. Buffett has openly credited Graham as his intellectual godfather, the guiding force behind his own extraordinary success. Calls the book by far the best book on investing ever written.
That's quite the endorsement. And that influence, it stems directly from Graham's own lived experience, right? That's part of what makes this book so powerful.
Exactly. Benjamin Graham wasn't some, ivory tower academic theorizing about markets from afar.
He was in the trenches.
He really was. He was a man who decided almost on a whim to give Wall Street a shot as a young man. Started as a humble clerk at a bond trading firm, immersing himself right there in the financial world.
Wow, starting right at the bottom?
Pretty much.
Yeah.
From there, he rapidly ascended, becoming an analyst, then a partner, and eventually he was running his own highly successful investment partnership. He learned his lessons not in classrooms, but on the unforgiving battlefield of real-world markets.
Often the hard way, I imagine.
Oh, definitely. Often through the costly crucible of trial and error.
So tell us about some of those early lessons. They really shaped his thinking, didn't they?
Yeah, absolutely did. His early career is peppered with these powerful lessons. Consider his chilling experience with the Savold tire fraud back in 1919.
Savold tire. Okay, what happened?
Well, Graham observed this new offering in the booming automotive industry. It seemed like a dream stock, It yielded a staggering 250% return on its very first day of trading.
Wow, 250% on day one.
Insane, right?
Okay.
But by October of that same year, just months later, the company was exposed as an outright fraud.
Oh, no.
Yeah, its stock plummeted to utter worthlessness. And for Graham, that wasn't just a loss. It was an early, harsh, and unforgettable lesson in the seductive dangers of speculative bubbles.
And the need for actual analysis.
Exactly. The paramount importance of fundamental analysis. It was a baptism by fire that irrevocably cemented his commitment to analytical rigor and a deep skepticism of market hype.
But he didn't just learn from losses, did he? He also learned how to spot real value others missed.
Precisely. He learned to uncover hidden value with painstaking detail. In 1925, Graham, with his almost, obsessive analytical mind, was plowing through these incredibly obscure reports filed by oil pipelines with the U.S. Interstate Commerce Commission.
Stuff most people would ignore.
Absolutely. Excruciatingly dull stuff for most.
Yeah.
But Graham found gold. He discovered that Northern Pipeline Co., a seemingly unremarkable entity then trading at just $65 per share, actually held at least $80 per share in high-quality bonds, basically, cash in the bank that the market was completely ignoring.
So the company was worth more dead than alive, almost.
In terms of liquid assets on hand, yes. And he didn't just buy the stock. He actively engaged with its complacent managers, pestering them to raise the dividend and unlock that latent value.
He wasn't passive about it.
Not at all. 3 years later, his tenacity paid off. He exited with $110 per share. That's not just insight. That's real-world success, built on meticulous research, an unwavering focus on true underlying value, and the courage to act on conviction.
That really demonstrates his whole approach in action.
It really does. And what's truly fascinating here, and something we'll keep coming back to, is how Graham's core principles, forged in the early 20th century, perfectly explain phenomena that occurred decades later.
Like what?
Well, the internet boom and bust of the late 90s and early 2000s, for instance. Or even the market's reaction to the unpredictable menace of global terrorism and war mentioned in the book's later updates. Graham, in essence, foresaw the destructive power of human emotion and hype in markets.
Because human nature doesn't really change.
Exactly. He understood that while technologies and global events change, human behavior, particularly our tendencies towards fear and greed, remains constant. So our mission for you today is to distill Graham's profound wisdom, to break down the book's core concepts.
Show how they apply today.
Right. Show how they apply to today's often unpredictable world and equip you with actionable insights to navigate your own financial journey, no matter what the market throws your way. We're going to unpack why these timeless truths matter more now than ever before.
Okay, so let's unpack Graham's foundational distinction, the very bedrock of his philosophy. The difference between investing and speculating. This isn't just semantics, is it? It's fundamental.
It's absolutely fundamental to everything Graham teaches and crucial for you to internalize. He defines an investment operation very specifically.
What's the definition?
It's an operation which, on thorough analysis, promises safety of principal and a satisfactory return.
Thorough analysis, safety of principal, and satisfactory return. All three.
All three. That definition is precise and uncompromising. And by extension, Graham considers any activity that doesn't meet those stringent criteria to be speculating.
Anything else is just gambling.
Pretty much. He views it as akin to casino gambling or betting on the horses. Thrilling. Yes, potentially rewarding if you're incredibly lucky on a single bet, but ultimately the worst imaginable way to build your wealth.
Why the worst? Because the odds are stacked against you.
Exactly.
Huh.
Because, as in any casino, the house always prevails against those who consistently try to beat it at its own speculative game. The odds are fundamentally stacked against the short-term gambler.
But many people chase those short-term wins. What's the hidden cost Graham saw?
Well, the hidden cost is often the transfer of wealth from the speculator to, say, the broker, or to the more disciplined long-term investor. As Graham sees it, investing is about making money for yourself through careful, reasoned decisions.
Right.
Speculating, on the other hand, frequently makes money primarily for your brokers, who profit from the constant churn of transactions driven by emotion and short-term predictions.
So lots of fees, lots of commissions.
You got it. Graham even puts it provocatively. True investing is a unique kind of casino one, where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor.
Okay, that's a bold claim. A casino where you can't lose if you follow the rules.
If you follow his rules, yes. He's essentially saying there's a way to participate in the market that's almost guaranteed to be profitable over time if you stick to a disciplined, value-oriented approach.
And this brings us to perhaps Graham's most powerful and, frankly, most humbling assertion. The investor's chief problem, and even his worst enemy, is likely to be himself. Why are we our own worst enemies in investing?
It boils down to our deeply ingrained human emotions, fear and greed, mostly. Graham warns us that while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street, it almost invariably leads to disaster.
Enthusiasm leads to disaster. That sounds counterintuitive.
On Wall Street, yes. Think about Sir Isaac Newton, a genius, right? Father of calculus, gravity.
One of the smartest people ever.
Absolutely. Yet he lost a fortune in the infamous South Sea bubble in the 18th century. He initially sold his shares for a tidy profit, saw everyone else piling in, got swept up in the mania.
FOMO, fear of missing out. Even Newton felt it.
Exactly. He jumped back in at a much higher price and lost the equivalent of millions today. He famously said he could calculate the motions of the heavenly bodies, but not the madness of people.
Wow.
And the dreadful losses, Graham points out, always occur after the buyer forgot to ask how much.
Forgetting the price relative to the actual value.
Precisely. Getting caught up in the story, the excitement, and ignoring the fundamental question, is this thing actually worth the price I'm paying?
Which leads perfectly into the Mr. Market analogy. This is probably Graham's most famous contribution, right? This idea of Mr. Market.
It's definitely one of the most enduring and useful. He personifies the stock market as your eccentric business partner.
Okay, paint the picture for us. Who is Mr. Market?
Imagine you own a share of a private business, maybe a local shop or something. And you have this partner, Mr. Market. Every single day, without fail, Mr. Market shows up.
Every day.
Every day. He knocks on your door and offers to either buy your share of the business or sell you his share. Now, here's the kicker. Mr. Market is moody, wildly erratic, prone to extreme swings between euphoria and deep depression. One day, he's absolutely ecstatic, convinced the future is limitless, offering you an outrageously high price for your shares.
Okay, thinks the business is worth a fortune.
Right. The next day, he's utterly depressed, convinced the business is doomed, maybe reads a bad headline, and he offers to sell you his shares at ridiculously low prices.
So completely bipolar.
Essentially, yes. Manic depressive is how Graham described him.
That's incredibly vivid. So what's the intelligent investor's response to this volatile partner? Do we have to listen to him?
Absolutely not. That's the key insight. The intelligent investor's response is simple and powerful. You have the profound advantage of being able to take advantage of the daily market price or leave it alone.
So you choose when to engage.
Exactly. It's dictated solely by your own independent judgment and inclination. For the true investor, these price fluctuations aren't a command to act, but rather a crucial opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal.
Take advantage of his moods, basically.
Use his irrationality to your benefit. At other times, when Mr. Market is just being, indifferent or acting crazy in ways that don't present clear opportunities, Graham advises, you will do better if you forget about the stock market and pay attention to your dividend returns and to the operating results of your companies.
Focus on the actual business, not the daily noise.
Precisely. The key is to be an independent judge of value, not a slave to market sentiment.
It's so relatable if you think about how we treat our other assets. Like, you wouldn't call a real estate agent every minute to check your house price, right?
Of course not.
And if the price quote changed, you wouldn't immediately rush to sell your house.
It would be absurd.
And Graham says you should view your portfolio of businesses in precisely the same way. Treat stocks like ownership stakes in real businesses, not just ticker symbols.
That's the core idea. And what's even more counterintuitive and often really difficult for new investors to grasp is that for anyone who will be investing for years to come, falling stock prices are actually good news, not bad.
Good news. That feels wrong. How can falling prices be good?
Because falling prices enable you to buy more for less money. It's like your favorite store having a perpetual sale on high-quality goods.
Ah, okay. So if you're still accumulating shares.
Right. The longer and further stocks fall, and the more steadily you keep buying as they drop, say, through a disciplined approach like dollar-cost averaging, the more shares you accumulate at lower prices, which means potentially much greater wealth in the end if, and this is a big if
you stick with it.
If you remain steadfast to your strategy and focus on value. This requires immense emotional discipline. Graham argues that by acknowledging your biological tendency to buy high and sell low, you can admit the need to dollar-cost average, rebalance, and even sign an investment contract with yourself.
Like a pre-commitment strategy against your own emotions.
Exactly. It's about putting your portfolio on permanent autopilot to actively fight what he calls prediction addiction. That constant, often destructive urge to react to Mr. Market's mood swings and try to guess what happens next. It's admission of our own human fallibility.
So, if our emotions and Mr. Market's moods are the enemy, how do we build that fortress around our investments? Graham gives concrete solutions, right? This leads us to his portfolio policy for the defensive investor.
Yes, the defensive investor is kind of the starting point for most people in Graham's framework. He lays out a very clear and, again, often counterintuitive portfolio policy. His fundamental guiding rule is to always maintain a significant part of their funds in bond-type holdings and a significant part also in equities.
Stocks and bonds. Okay, that sounds standard.
It is, but the emphasis is on maintaining that balance structurally, not trying to time shifts between them. It's about establishing stability, a permanent balance, regardless of what the market is doing day to day.
And he gives quite precise parameters for this balance, doesn't he? What are those ranges?
He does. He suggests never less than 25% or more than 75% in common stocks, with a corresponding inverse range for bonds. So 75% stocks means 25% bonds, 25% stocks means 75% bonds.
And the middle ground?
The standard division should be an equal one, or 50-50. That's his default recommendation.
Okay, 50-50 stocks and bonds. What's striking about this compared to, say, typical advice today?
What's truly striking, and something that firmly sends his advice against the winds of conventional wisdom today, is that Graham never mentions the word age when discussing asset allocation.
Never mentions age. That's huge. Most advice today is all about your age dictating your stock-bond mix.
Right, like the old 100 minus your age rule for stocks. Graham didn't buy that. He didn't believe age dictates your risk tolerance in the way many modern advisors suggest. For him, it was more about your psychological makeup, your financial situation, and your ability to tolerate market fluctuations without panicking.
Interesting. So it's about temperament, not just time horizon.
Exactly. And instead of age, Graham emphasizes another crucial, often overlooked factor, inflation.
Ah, the silent killer of wealth.
Precisely. He views it as a hidden enemy that constantly erodes purchasing power, silently diminishing your wealth. He pointed to historical contexts like 1950-1920, when the cost of living nearly doubled,
Wow.
and 1965-1970, which saw a 15% rise in just 5 years. His clear implication is that investors should clearly allow for the probability of continuing or recurrent inflation to come.
So you can't just hide in cash or only low-yield bonds.
Exactly. You can't simply preserve your capital in nominal terms. You must grow it faster than inflation eats away at it. And that typically means some exposure to equities, to businesses that can potentially raise prices and grow earnings over time.
So bonds provide a buffer, but stocks are needed for growth against inflation.
That was his view. Bonds provide stability and protection of principal, but well-chosen stocks, held for the long term, are necessary to truly outcase the hidden tax of inflation. It's a constant threat you have to factor into your long-term strategy.
Okay, so for this defensive investor, balancing stocks and bonds, fighting inflation, how do they actually pick the stocks? Graham isn't asking us to become full-time analysts, is he?
Not at all. That's key for the defensive investor. Graham's goal isn't for them to dramatically beat the market or uncover hidden gems. It's about safety and sufficiency.
Minimum quality, minimum quantity.
You got it. He aims to obtain a minimum of quality in the past performance and current financial position, and a minimum of quantity in terms of earnings and assets per dollar of price. It's about avoiding big mistakes, not hitting home runs.
And he provides very specific criteria for this, almost like a checklist.
Yes, very much like a checklist, designed to filter out risky or overvalued companies. It's quite practical.
Give us some of those criteria. What does a defensive stock look like, according to Graham?
Okay, first, he looks for sufficient size of the enterprise. He wasn't interested in tiny, unproven companies for the defensive portfolio. He wanted established companies, often leaders in their industries, which tend to be more stable and resilient.
Bigger companies, generally safer. Makes sense.
Second, a sufficiently strong financial condition. This is crucial. He had specific metrics, like current assets being at least twice current liabilities.
The current ratio.
Exactly. And long-term debt not exceeding net current assets or working capital.
Mm-hmm.
This sounds like accounting jargon, but it's Graham's acid test for financial strength. It ensures a company isn't over-leveraged and has a solid cushion.
Less likely to go bankrupt if things get tough.
Much less likely. Third, he demanded earnings stability, positive earnings, for the past 10 years. No losses allowed in that decade for a defensive pick. This proves consistent profitability through different economic cycles.
10 years of profits, that's a solid track record.
It is. Fourth, a consistent dividend record with uninterrupted payments for 20 years or more.
20 years of dividends.
Yep. This isn't just about income, though that's nice. For Graham, it was a powerful signal of financial health and management's commitment to shareholders. A company that can pay dividends consistently for decades is almost certainly generating real, sustainable cash flow.
Hard to fake that for 20 years.
Very hard. Fifth, he looked for some earnings growth, at least 1/3 increase in per-share earnings over the past 10 years, using 3-year averages at the beginning and end. So not just stable, but showing some moderate progress.
Okay, so not stagnant.
Right. And finally, perhaps most importantly, valuation is paramount. A moderate price-earnings ratio, no more than 15 times the average earnings of the past 3 years.
PE ratio under 15. That filters out a lot of popular stocks today.
It certainly does. And also a moderate price-book value, suggesting a price no more than 1.5 times the net asset value, book value. He even combined these, suggesting the products of the PE ratio and the price-book ratio shouldn't exceed 22.5, which is 15 times 1.5.
Wow, very specific valuation hurdles.
Very specific. These prevent you from buying a decent company at an irrational price, which, as we discussed, is where most big losses happen.
That's incredibly practical. It really is like a checklist. And this is why today, many argue that a low-cost index fund, ideally one that tracks the return of the total U.S. stock market, is a good way for defensive investors to achieve these goals, right?
Precisely. It's a very sensible, modern application of Graham's defensive philosophy. An index fund automatically gives you diversification across many large established companies.
Companies that, on average, would likely meet many of Graham's quality criteria.
Exactly. And it does so at a very low cost. It takes away the need for individual stock picking, which Graham acknowledged was difficult, while still benefiting from the inherent quality and diversification he sought. It's passive implementation.
Makes sense. Now, this focus on fundamentals and diversification leads us to challenge another popular investing idea, especially from the 80s and 90s. Peter Lynch's buy what you know.
Ah, yes, the Peter Lynch mantra. Very popular.
Lynch argued that amateur investors actually have an advantage through their common knowledge of great products or services, liking the coffee at Starbucks or the clothes at Gap. But Graham, reading between the lines, would have strongly pushed back against this, wouldn't he?
Oh, absolutely. Graham would argue that buy what you know is potentially dangerous because it ignores the absolute necessity of due diligence, that thorough analysis piece.
Just liking the product isn't enough.
Not even close. Knowing a product tells you nothing about the company's financial health, its debt load, its management quality, its competitive landscape, or, crucially, its valuation. Is it actually cheap relative to its prospects?
So it falls prey to human bias, the familiarity trap.
Exactly. No matter how confident we feel, Graham would remind us, there's no way to find out whether a stock will go up until after we buy it. Relying solely on product familiarity is a fundamentally speculative mindset, mistaking consumer experience for investment analysis.
Which is why Graham hammered on diversification. It wasn't just a good idea. He called it the only reliable insurance against the risk of being wrong.
The only reliable insurance. Because you will be wrong sometimes.
Can you give us an example of how bad it can get when investors concentrate based on knowing a popular company, especially a tech darling?
Oh, the commentary on Graham's work points to MicroStrategy as a chilling, more recent example. This company was a darling of the dot-com boom. Its software was well regarded.
Right, people knew it.
They thought they did. It peaked at an eye-watering $3,130 per share in March 2000. Seemed like an obvious buy if you believed in the internet's future.
Okay, $3,130. What happened?
By year-end 2002, just 2.5 years later, it had collapsed to $15.10 per share.
$15 from over $3,000.
Yep, a gut-wrenching 99.5% loss. That's a stark reminder that even the most promising, seemingly well-known companies can implode if bought at the wrong price, or if fundamentals deteriorate. Diversification is your parachute when one engine fails.
So connecting this back, Graham's point about the knowledge of how little you can know about the future, coupled with the acceptance of your ignorance, is a defensive investor's most powerful weapon.
It's really about intellectual humility.
Precisely. It's an admission that we cannot predict the future, and therefore we must build a system diversification, margin of safety, strict criteria that protects us from our inevitable mistakes and the market's inherent unpredictability.
Which brings us to navigating the market itself, particularly understanding reported earnings. Most investors just look at that headline EPS number, right?
They do. The earnings per share figure gets all the attention.
But Graham dedicates a whole chapter, chapter 12, warning against taking those figures as published at face value. Why was he so skeptical? Because Graham understood that financial accounting, well, based on rules, involves a lot of judgment and estimation. It's not an exact science. Companies have various tools and discretion, and these accounting factors can significantly impair true comparability between firms, or even within the same firm over time.
So the numbers can hide more than they reveal sometimes.
They absolutely can. For instance, companies might use special charges, large, irregular write-offs for things like restructuring or asset impairments.
Okay, like a one-time hit.
Right. But the company could strategically time these. Maybe throw all the bad news into one bad year to take a big bath accounting-wise.
The kitchen sink approach.
Exactly. Clear the decks. Then, in subsequent years, earnings can look miraculously better, showing record growth, even if the underlying operations haven't fundamentally changed that much. It's a way to manage perceptions.
That's a classic move. And he uses that example of AAA Enterprises later on, right? A company built on hype and possibly dubious numbers.
Yes. AAA Enterprises is a cautionary tale threaded through the book. Sold shares at $14 in 1968, based largely on the magic word franchising, and a few years of appealing numbers.
Shot up initially.
Yep, doubled to $28 quickly.
Yeah.
But by early 1971, it was quoted at a dismal 25 cents and soon entered bankruptcy. The reported earnings clearly obscured fundamental problems.
What else should investors watch out for in reported earnings?
Well, another thing is how past losses can affect the income tax deduction. If a company had big losses previously, it might have tax loss carry-forwards.
Right, so they pay less tax now.
Exactly, which means their current net income looks artificially higher than it would be if they were paying a normal tax rate.
Yeah.
They appear more profitable than their operations might justify on a sustainable basis.
That's sneaky. Then there's the dilution factor from things like stock options or convertible bonds. How does that obscure the picture?
It creates a potential future headache. If a company issues lots of stock options to executives, or has convertible bonds or preferred stock out there.
Stuff that can turn into common stock later.
Right. Those potential future shares aren't always fully reflected in the current reported earnings per share calculation, especially if they aren't considered dilutive under accounting rules yet. So EPS can look fantastic today. But if those options are exercised or those bonds are converted, the total number of shares increases sometimes significantly. This means future earnings per share will be lower, even if total company profits stay the same or grow modestly.
So the pie gets divided into more slices later?
Exactly. It's an illusion of higher per share profitability today. Graham noted numerous exceptions where this was significant, especially with the fast-expanding conglomerates of his era, who played what he called convertible ledger domain, fancy accounting tricks.
Okay, so watch out for potential dilution. What other accounting choices did Graham highlight?
Several others. Depreciation methods, for one.
Yeah.
Companies can choose between straight-line depreciation, spreading the cost evenly, or various accelerated methods, taking more cost up front.
And that changes reported profit.
Dramatically sometimes, even if the actual cash flow from the business hasn't changed. He cites Trainco in 1970, reporting a 20% earnings increase. But half of that jump came just from changing their depreciation method to an older, less conservative one.
Wow, just an accounting change.
Just an accounting change. Also, how companies treat research and development costs, expensing them immediately versus capitalizing and amortizing them over time. And even inventory valuation methods like FIFO, first in, first out, versus LIFO, last in, first out, can impact reported costs and profits, especially when prices are changing rapidly.
So many ways the numbers can be presented differently.
Exactly. The big takeaway from Graham is crucial. The more seriously investors take the per-share earnings figures as published, the more necessary it is for them to be on their guard. You can't just read the headline number. You have to try and understand how it was constructed. Look at the footnotes.
Read the footnotes. Good advice. This vigilance becomes even more critical when we look at the perils of overvaluation, particularly with so-called growth stocks.
Ah, yes, growth stocks. The siren song of investing.
They can bring phenomenal rewards, Graham admitted, citing early IBM as an example. But he still considered them too uncertain and risky a vehicle for the defensive investor. Why so wary?
Because the price you typically have to pay for exciting growth stocks often embeds enormous, heroic assumptions about future performance assumptions that are simply unknowable and often turn out to be wrong.
You're paying today for potentially decades of future success that might not materialize.
Precisely. And history is littered with examples of even the best growth stocks suffering massive declines. Graham pointed out IBM losing half its value twice in the 60s. Texas Instruments soaring from $5 to $256, then crashing by 4/5 to $49 just 2 years later.
Ouch.
And the commentary updates this with modern parallels. Microsoft dropping over 55% from 2000 to 2002. Cisco losing 76% over the same period after its incredible run-up. Graham's quip holds true. As always, the hotter they are, the harder they fall.
It's not necessarily about the quality of the company itself, but the irrational price paid for it.
Exactly. The risk isn't always the business, it's the valuation.
And the core problem, Graham argues, lies with projections. We're constantly fed these scientific analyses predicting future earnings, future stock prices.
Wall Street loves projections.
But Graham called this highly unreliable. Why did he have so little faith in forecasting?
Because, as he pointed out, any dependable stock evaluation based on anticipated future results must take future interest rates into account. Think about it. The value of future earnings depends heavily on the discount rate you use, which is tied to interest rates.
And predicting interest rates years out is difficult.
Extremely difficult, maybe impossible, especially given, as he noted even then, the recent violent swings in long-term interest rates. How can you reliably predict a company's earnings 10 years from now and predict the interest rates that will prevail then to discount those earnings back?
It's compounding uncertainty upon uncertainty.
Right. Graham directly warns, let the reader not be misled into thinking that such projections have any high degree of reliability. He viewed complex, long-range forecasts with extreme skepticism. The further out the projection, the closer it gets to pure guesswork.
This skepticism ties directly into the IPO merry-go-round, doesn't it? that cycle of hype and disappointment with new stock offerings.
It does, perfectly. Graham observed this pattern repeating throughout market history. The public gets excited about new issues, often fueled by flimsy projections and hype.
It's burned.
Gets burned badly when the hype fades and reality sets in. They swear off IPOs for a while, become cautious.
Until the next hot trend comes along.
Exactly. Then they forget the previous pain and jump back in for another scolding, as Graham put it. He even cites an 1825 stampede of speculators trying to buy shares in a new bank, a frenzy that contributed to a major market downturn.
History repeating itself. And he had personal experience early on, right?
With Savile Tire in 1919. That perfectly illustrates the initial IPO hype followed by total collapse when the fraud was revealed.
And there are plenty of modern examples in the commentary. VA Linux.
Oh, VA Linux in 1999 is a classic .com IPO story. IPO'd at $30.
Okay.
Peaked at $320 on the first day, closed at $239.25 for nearly 700% gain from the IPO price.
Insane first-day pop.
Totally insane. But the commentary notes that gain was earned by only a handful of institutional traders. Individual investors were almost entirely frozen out. They couldn't get shares at $30.
They had to buy later at much higher prices.
If they could buy it all. And the frenzy. Traders were simply inflamed by the words software and internet for a company that, crucially, had never made a dime in profits. It was pure speculation on buzzwords.
Just like franchising drove AAA Enterprises.
Exactly the same pattern. AAA Enterprises sold to $14.68, doubled quickly, then crashed to 25 cents in bankruptcy by 71. Based on the magic word franchising and little else, Graham saw these IPO frenzies, along with what he called dopey ideas or formulas.
Like the January effect or the Foolish Four.
Right. Things that seemed to offer a mechanical way to beat the market. He saw them all as falling prey to what the commentary calls Graham's Law. All mechanical formulas for earning higher stock performance are a kind of self-destructive process akin to the law of diminishing returns.
Why self-destruct?
They either fade because they were just statistical flukes or coincidences in the first place, or, if they ever did have some validity, their publicity causes so many people to try them that the effect gets arbitraged away. Everyone rushes in, and the advantage disappears.
So there's no sustainable magic formula.
Not according to Graham. They offer the illusion of easy money, but they never deliver enduring wealth. Diligence and discipline are required.
Okay, so that covers the defensive investor and the common pitfalls. But Graham also discussed a path for the enterprising investor. How does this differ?
The enterprising or aggressive investor starts from the same basic foundation that balanced stock-bond portfolio, but they are prepared to branch out into other kinds of security commitments that require more work and skill.
So more active, more research-intensive.
Definitely. It's not about taking more risk blindly, but about being willing to do the deep analysis needed to justify departures from the simpler defensive strategy. They need a well-reasoned justification, as Graham put it.
What kinds of areas might they explore? He mentioned second-grade bonds and preferred stocks.
Right. These offer higher yields than top-quality bonds, but they come with significantly greater individual company risk. You really have to understand the issuing company's finances and the specific terms of the bond.
Not for the casual investor?
Generally not. Graham advises the ordinary investor to keep away from such high-yield bonds unless they have specialized knowledge. It requires intensive study.
This is where the modern term junk bonds fits in, right? What was Graham's take?
He acknowledged that bargain opportunities occur fairly often in lower-grade bonds, but stressed they require special study and skill to exploit successfully, while the overall junk bond market might show decent long-term returns after accounting for defaults.
The average return might look okay.
Right. But picking individual junk bonds is treacherous, and most funds specializing in them charge high fees, which eats into those potential extra returns.
And the potential downside is catastrophic, like with WorldCom.
WorldCom is the nightmare scenario. Its bonds offered juicy yields, up to 8% for a bit, looked attractive on the surface.
Until it wasn't.
Until it filed for bankruptcy and admitted to overstating earnings by billions. Bondholders were wiped out. As the commentary says, no yield could ever be high enough to compensate an investor for risking that kind of explosion. It highlights that focusing only on yield without assessing principal risk is incredibly dangerous.
A hard lesson. Graham also discusses special situations. These sound complex. What are they?
They are definitely complex and require real expertise. Graham describes them as things like Intersecurity arbitrages, profiting from price discrepancies between related securities, payouts or workouts and liquidations, buying stocks of companies being liquidated for less than their expected payout, and protected hedges of certain kinds.
Sounds like professional territory.
Mostly, yes. The most typical case he mentions is a projected merger or acquisition. If Company A agrees to buy Company B for $50 a share, and Company B's stock is trading at $45 after the announcement.
There's a $5 potential profit if the deal goes through.
Right. The special situation investor, or arbitrager, analyzes the likelihood of the deal closing, the timing, the risks, and tries to capture that spread.
But Graham also noted that these became less profitable over time.
He did. As more people tried to play this game, with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Competition increased, spreads narrowed, and risks rose.
So even the experts found it harder.
Yes. Eventually, Graham's own investment firm limited their involvement in these, focusing more on self-liquidating situations or working capital bargains, where the outcome was less dependent on external events like deal approvals. It shows that even sophisticated strategies can lose their edge.
Let's shift gears to corporate governance. Graham starts with this ideal. The stockholders as a class are king. Sounds great in theory.
It does sound like shareholder democracy. Acting as a majority, they can hire and fire managements and bend them completely to their will. But Graham immediately punctures that balloon. In practice, he observed bluntly, the shareholders are a largely inert and supine body.
Inert and supine. Ouch. Basically passive and lazy.
Pretty much. This shareholder complacency, he argued, creates a power vacuum that self-serving or simply incompetent management can easily exploit, and that can cost passive investors dearly.
And we've seen horrifying examples of this as the updated commentary highlights. The scandals at Enron, WorldCom, Tyco.
Exactly. The commentary calls it the latest epidemic of scandal, involving allegations of managerial misbehavior, shady accounting, or tax maneuvers at major firms. It's a stark reminder that Graham's earlier warnings about the need for eternal vigilance are more vital than ever.
Enron is the poster child, isn't it? How could investors have spotted trouble there, according to Graham's principles?
Enron is a perfect case study in why reading the fine print matters. Back in 1999, it looked like a corporate titan. But the commentary points out that a prudent investor, simply by reading its 1999 proxy statement, that document sent out before the annual meeting.
The one most people probably toss in the bin.
Sadly, yes. But that proxy disclosed that Enron's chief financial officer, Andrew Fastow, was involved in these off-balance sheet partnerships, LJM1 and LJM2. And these partnerships were buying assets from Enron, sometimes even with money borrowed from Enron.
Whoa! The CFO doing deals with the company using the company's money.
It was a blatant, glaring conflict of interest, essentially signaling that management was playing games, doing deals with itself, likely to hide losses or inflate earnings. The warning signs were there, buried in the proxy.
That's chilling. And the consequences were devastating elsewhere, too. Tyco
lost $9.4 billion in fiscal 2002. Stock dropped 71% in 12 months amid allegations of looting by executives. West had to restate its financials, one of over 300 companies that did so in 2002 alone. These weren't isolated incidents.
It really underscores Graham's point about vigilance. So what can you, the individual investor, actually do? We can't all run the company.
No, but you can be informed. Graham advises judging management by results comparing profitability, size, and competitiveness against similar firms in its industry. Do your homework. Don't just trust the press releases.
And if management seems subpar or unethical?
Graham believes shareholders should act. A few of the more substantial stockholders should become convinced that a change is needed. The rank and file should be open-minded enough to read the proxy material and to weigh the arguments. He even suggested bringing in outside experts to evaluate management if results were poor. It's a call for informed engagement, not blind trust. Use your vote.
He also had strong views on dividends versus stock buybacks, which is a hot topic today. Many companies prefer buybacks. What was Graham's stance?
Graham was generally pro-dividend. He felt quite strongly that the burden of proof is on the company to show that you are better off if it does not pay a dividend.
The default should be to pay it out.
Yes. If a business was faltering or underperforming its rivals, he argued that refusing to pay a dividend and just hoarding cash was potentially misusing the cash. It suggested management either couldn't find productive reinvestment opportunities or, worse, was trying to mask problems. For Graham, a consistent dividend was a sign of health, discipline, and respect for shareholders.
And he was critical of buybacks done at high prices. He called it cynical waste.
He did. He argued companies should buy back their shares when they are cheap, not when they are at or near record highs. He saw it becoming all too common for companies to repurchase their stock when it is overpriced.
Why would they do that?
Often, he suspected, to prop up the stock price temporarily, or, more cynically, to allow executives to reap multi-million-dollar paydays by selling their own stock options into the buyback-supported price.
Connecting it back to executive incentives.
Exactly. Think about stock options. Their value increases with price volatility and stock price appreciation. Dividends, however, tend to dampen volatility and take cash out of the company that could otherwise boost the stock price or be used for buybacks.
So paying higher dividends might actually reduce the value of executive stock options.
Potentially, yes. This creates a subtle but powerful conflict of interest. Management might favor buybacks, which boost EPS and potentially the stock price, benefiting their options, even when a dividend might be better for long-term shareholders. It's something investors need to be aware of.
Very insightful. Lastly, on navigating the system, Graham had pointed advice about brokerage houses and financial advisors. What was his main caution?
His fundamental caution was skepticism. He stated unequivocally that the intelligent investor will not do his buying and selling solely on the basis of recommendations received from a financial service. Don't just blindly follow tips.
So what's their role then?
He saw their role as useful for supplying information and offering suggestions. But, crucially, the investor must insist on passing his own judgment upon them. You are the ultimate decision maker.
Do your own thinking.
Always. And he advised critical due diligence when choosing an advisor. Ask for their resume, check their background, like their Form ADV disclosure. Ask for references, check for past complaints.
And ask about their philosophy.
Yes. Critically, ask how they define financial success and what average annual return they think is realistically achievable. Graham suggests anything consistently promised above, say 8% to 10% over the long term, should be viewed with extreme caution. If an advisor promises the moon,
Run the other way.
pretty much, it likely points back towards speculation, not sound investment.
Okay, so this brings us to the absolute core, the unifying principle of the entire book, the margin of safety. Graham calls it the central concept of investment. What does that really mean for us?
It is absolutely central. It means buying a security for significantly less than your best estimate of its intrinsic value, its true underlying worth.
So getting a discount.
A significant discount. Think of it like building a bridge designed to hold 10,000 pounds, but you only ever plan to drive vehicles weighing 5,000 pounds over it. That 5,000-pound difference is your margin of safety.
The buffer.
Exactly. In investing, it's the buffer between the price you pay and the value you estimate you're getting. This margin, Graham explains, provides a very real margin of safety, which, under favorable conditions, will prevent or minimize a loss if your analysis is a bit off, or if things don't turn out quite as well as expected.
It's protection against being wrong or unlucky.
Precisely. Your ultimate protection against the uncertainties of the future and your own inevitable errors in judgment.
And he emphasizes that applying this consistently, especially with diversification, dramatically increases your odds of success.
Yes. With a diversified list of 20 or more stocks, each bought with a reasonable margin of safety, the probability of a favorable result under fairly normal conditions becomes very large.
Why is diversification so crucial with the margin of safety?
Because even the most careful analysis can be wrong about an individual company. You might buy stock X with a 30% margin of safety, thinking it's worth $100 and paying $70. But maybe something unforeseen happens, a new competitor, a regulatory change, and it turns out it was only worth $60 or less.
So you still lose money on that one.
You might. But if you own 20 stocks, all bought with a similar apparent margin of safety, the winners should more than compensate for the occasional losers. Diversification smooths out the risk of individual errors or bad luck. It works hand in glove with the margin of safety.
And it protects you particularly from the biggest danger.
Right. Graham states the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. That's when hype is highest.
When everything looks rosy.
Exactly. People mistake temporary good earnings for permanent earning power, and wrongly assume that prosperity is synonymous with safety. This is exactly when common stocks of obscure companies can be floated at prices far above the tangible investment on the strength of 2 or 3 years of excellent growth with absolutely no margin of safety baked into the price.
Paying peak prices for peak earnings, assuming the peak lasts forever.
Which it rarely does. That's where the margin of safety is most needed and often most absent.
You mentioned earlier this idea of connecting the margin of safety to Pascal's wager. Can you explain that analogy? It sounds intriguing.
It's a powerful way to think about risk and consequences. Pascal's wager is a philosophical argument about belief in God. Simplified, it says, if you bet that God exists by living virtuously, and you're right, you gain infinite reward, heaven. If you're wrong, you lose little, maybe missed out on some earthly pleasures. If you bet that God doesn't exist by living sinfully, and you're right, you gain little, those earthly pleasures. But if you're wrong, you face infinite loss, hell. So the rational bet, Pascal argued, is to believe.
How does that apply to investing?
The parallel is about managing the consequences of being wrong. The probability of making at least one mistake in your investing lifetime is virtually 100%. You will be wrong sometimes.
Guaranteed.
Right. However, you do have control over the consequences of being wrong. Buying with a large margin of safety is like betting on the virtuous path in Pascal's wager. If your analysis is right, you do well. If your analysis is wrong, the margin of safety cushions the blow, your loss is limited.
But if you speculate buying hyped stocks at high prices with no margin of safety.
That's like betting against God in Pascal's wager. If you happen to be right, pure luck, your gain might be significant in the short term. But if you're wrong, the consequences can be catastrophic, huge, permanent losses of capital.
Like the dot-com investors who put everything into tech stocks in '99?
It's exactly. The commentary says many investors who put 85% or more into dot-coms then took the wrong side of Pascal's wager. They ignored Graham's call for safety, betting everything on an unproven future with no downside protection. The intelligent investor focuses on minimizing the chance of disaster, even if it means missing out on some speculative frenzy.
So Graham isn't asking for perfection. He's asking you to build a system that protects you when you're inevitably not perfect.
That's the essence of it. And even Graham himself practiced this. Despite averaging a remarkable 20% annual return for his partnership, which is incredible, he managed risk meticulously. He was often too quick to dispose of issues that had advanced to levels they deemed no longer attractive, locking in gains, ensuring safety, and always maintained a well-diversified portfolio.
Except for that Geico investment. That sounds like a huge concentrated bet.
It was concentrated, about 25% of his fund. But it exemplifies the intelligent application of risk. Before putting that much in, Graham had painstakingly established that he could liquidate Geico for at least what he paid for it, based on its solid assets and predictable insurance operations, even if the stock market completely ignored it.
So the financial risk was actually low, even if the concentration was high.
Exactly. He assessed the downside first. It was taking very little financial risk in terms of potential capital loss. The courage required was psychological. The courage to make such a large bet on an obscure stock based on his own deep analysis when few others saw the value. He had a massive tangible margin of safety protecting his downside.
And his most famous student, Warren Buffett, constantly echoes this margin of safety principle. The Washington Post example from 1973 is classic.
It really is. The whole company, Washington Post, was selling in the stock market for about $80 million total. But Buffett, applying Graham's analysis, figured its tangible assets, its TV stations, real estate, the newspaper itself could probably be sold off individually for not less than $400 million, maybe even $500 million.
So buying $1 worth of assets for maybe 20 cents.
Or less.
Yeah.
Buffett famously questioned how modern finance theory, using beta or volatility as a measure of risk, could possibly say that buying those $400 million of assets for $40 million, if the stock price fell further, which it did briefly, was riskier than buying them for $80 million.
It makes no sense when you put it like that. Lower price should mean lower risk.
Exactly.
Yeah.
Buffett called the academic view truly Alice in Wonderland. For Graham and Buffett, true risk isn't price volatility. It's the risk of permanent capital loss. And that risk is minimized by buying with a large margin of safety, paying much less than something is truly worth.
And Buffett's incredible track record, especially with his partnership early on, consistently outperforming the market.
It provides decades of proof that Graham's principles work in practice. The tables showing the Buffett partnership results versus the Dow are compelling evidence. Though Buffett himself notes that size eventually becomes an anchor of performance, it's harder to find huge bargains when managing billions. But the core philosophy remains.
Okay, this has been a fantastic deep dive. Let's try to crystallize the key actionable insights for everyone listening from The Intelligent Investor first, and maybe the absolute starting point.
Always distinguish clearly between investing and speculating. Know which game you're playing. Investing demands thorough analysis, aims for safety of principle first, and seeks a satisfactory, not necessarily spectacular, return over the long term.
While speculation is short-term, involves market timing or chasing fads, carries high risk, and often benefits your broker more than you.
Sad, but often true. Second, embrace Mr. Market. See him as your often irrational but potentially useful servant, not your master.
Use his moods. Buy when he's depressed, prices are low. Consider selling when he's euphoric, prices are high. And crucially,
Feel perfectly comfortable ignoring him completely most of the time. Focus on the underlying business value, not the daily ticker. Don't let his irrationality sway your emotions or force you into action.
third, build and maintain a balanced, diversified portfolio. Remember Graham's default 50-50 stock bond split and the 25% to 75% bands.
And remember, for Graham, that allocation depends more on your temperament and ability to withstand fluctuations than simply your age. Plus, ensure your portfolio accounts for the long-term corrosive effect of inflation.
Fourth, be a skeptical owner. Scrutinize company earnings reports, read the footnotes, understand potential accounting games, and watch management's actions, particularly around compensation, buybacks, and dividends. Are they aligned with your interests as a shareholder?
Vigilance is key. Don't just blindly trust. Verify.
Fifth, and this is the cornerstone, always demand a margin of safety. This is the single most important concept. Buy assets for significantly less than you estimate they're worth.
This provides your buffer against errors, bad luck, and the unknown future. It's the bedrock of minimizing risk and achieving satisfactory long-term results. Embrace the long view, resist emotional decisions driven by Mr. Market's noise or the crowd's hysteria.
It really feels like Graham gives you not just investment rules, but a whole mental framework.
That's exactly right. What's truly fascinating, and why the book remains so relevant, is that while markets, technologies, and global events constantly change, human nature doesn't. Fear, greed, impatience, overconfidence, these are constants.
The same mistakes get made over and over.
Precisely. Graham gives you an invaluable framework not just to analyze companies, but maybe more profoundly, a framework to analyze yourself and your own behavioral biases. Understanding and controlling those is often the real key to avoiding major investment errors.
So as you, our listener, go back out into the world of daily headlines, endless market noise, and the constant siren calls of the next sure thing, consider this final thought.
If Mr. Market knocked on your door tonight, offering to buy or sell your entire investment portfolio, what price would you offer him for it, based only on your rational assessment of its true underlying business value, forgetting today's quoted price completely?
And perhaps more importantly, what would your answer to that question tell you about your own financial wisdom, your discipline, and whether you're truly acting as an intelligent investor?